Question 9. Why does the issuer believe that Nasdaq 100 covered call ETF strategy is well suited for current market conditions? Based on the characteristics of the strategy and current market trends, we can speculate on some potential reasons here. Current market considerations here. 1. Volatility. The current market exhibits increased volatility compared to past years. Covered call strategies can benefit from volatility, as options premiums tend to be higher during volatile periods, potentially leading to increased income generation for QYLD. 2. Uncertain outlook. The global economic and political landscape is uncertain, with potential for both bull and bear market scenarios. QYLD's strategy offers some downside protection through selling covered calls, potentially mitigating losses in declining markets while still generating income. 3. Lower interest rates. Traditional fixed income investments like bonds offer lower yields in the current low interest rate environment. QYLD's higher potential income compared to these options might be attractive to investors seeking higher returns. Alignment with QYLD's strategy. 1. Income focus. QYLD primarily focuses on generating income through the covered call strategy. The current market conditions mentioned above could potentially benefit this income generation, aligning with QYLD's objective. 2. Moderate downside protection. The covered call strategy offers some downside protection, which might be appealing in volatile or uncertain markets. 3. Diversification within growth. QYLD's exposure to the Nasdaq 100 might be seen as beneficial in a scenario where some growth potential remains despite the uncertain outlook. Question 10. Why might investors choose Nasdaq 100 covered call ETF over other covered call ETFs or similar investment vehicles? Several reasons might lead investors to choose the Nasdaq 100 covered call ETF, QYLD, over other covered call ETFs or similar investment vehicles. Target index. 1. Nasdaq 100 exposure. QYLD offers exposure to the Nasdaq 100, a well-known index of 100 large U.S. growth-oriented companies. This potentially provides diversification, with some upside potential compared to narrower indices or specific sectors. 2. Moderate volatility. The Nasdaq 100 generally exhibits moderate volatility compared to other indices, which can be beneficial for covered call strategies, as it balances premium generation and potential downside protection. Strategy implementation. 1. Automation. QYLD automatically implements the covered call strategy, eliminating the need for individual stock selection and option management, which can be complex and time-consuming. 2. Short expirations. QYLD primarily uses short-term, monthly, expirations for its covered calls. This maximizes the number of premiums collected throughout the year, potentially leading to higher income generation. Income-focused. 1. High dividend yield. QYLD boasts a significantly higher yield than passively tracking the Nasdaq 100 due to the covered call strategy. This attracts income-seeking investors, especially retirees, or those needing a steady cash flow. 2. Income stability. The covered call strategy generates income regardless of the stock price direction, potentially offering more stable income compared to dividend stocks with fluctuating payouts. However, it's crucial to consider the drawbacks compared to other options. 1. Limited upside. By selling covered calls, QYLD caps its potential gains if the stock price significantly rises, potentially underperforming other covered call ETFs or investments in bull markets. 2. Higher volatility. QYLD can experience higher volatility than other covered call ETFs or income-generating investments due to the options component. 3. Fees and expenses. Implementing a covered call strategy adds complexity, leading to higher fees compared to passively tracked ETFs or other investments. Alternatives to consider. 1. Other covered call ETFs. Explore ETFs with different underlying indices, strike selection strategies, or expiration periods to align with your specific goals and risk tolerance. 2. Dividend stocks. Consider dividend-paying companies with consistent track records and lower volatility for a balance between income and capital appreciation. 3. Bonds. Bonds offer predictable income streams with lower volatility, although yields may be lower than QYLDs. Question 11. Why does Nasdaq 100 covered call ETF emphasize consistent income generation as a primary objective? There are several reasons why the Nasdaq 100 covered call ETF, QYLD, emphasizes consistent income generation as its primary objective. Target audience. 1. Income-seeking investors. QYLD primarily targets investors seeking steady and consistent income, such as retirees, income-dependent individuals, or those looking to supplement their income. This audience prioritizes regular cash flow over maximizing capital appreciation. 2. Market conditions. The covered call strategy can be particularly appealing in volatile or uncertain market environments. By generating income regardless of the stock price direction, QYLD offers some stability and predictability compared to other investment options that might fluctuate significantly. 3. Tax implications. QYLD distributes income primarily as non-qualified dividends, which are taxed at a lower rate for some investors compared to capital gains taxes. This can be attractive for income-focused investors seeking tax-advantaged returns. Strategy alignment. 1. Covered call mechanics. The core of QYLD's strategy involves selling covered calls, which generate premium income upfront regardless of the stock price movement. This directly aligns with the objective of consistent income generation. 2. High dividend yield. Due to the covered call strategy, QYLD boasts a significantly higher dividend yield compared to passively tracking the Nasdaq 100 index. This yield attracts income-seeking investors seeking a steady stream of cash flow. 3. Limited upside potential. While the covered call strategy provides income, it also caps the potential gains from significant stock price increases. This aligns with the focus on consistent income over maximizing capital appreciation. Alternatives and limitations. 1. Comparison to other income-generating options. QYLD offers a higher yield compared to traditional dividend stocks or bonds, making it attractive for income-focused investors who might find these options insufficient. 2. Limited capital appreciation. Investors seeking high growth or capital appreciation might find QYLD unsuitable due to its limited upside potential. 3. Higher volatility. The covered call strategy can lead to higher volatility in the ETF's price compared to other income-generating options. Overall, The Nasdaq 100 Covered Call ETF's emphasis on consistent income generation stems from its target audience, its core strategy, and its alignment with specific investor needs. However, it's crucial to understand the limitations and potential drawbacks, such as limited upside potential and higher volatility, before investing. Question 12. Why might Nasdaq 100 Covered Call ETF be more or less volatile than the broader market? The Nasdaq 100 Covered Call ETF, QYLD, can be both more or less volatile than the broader market, depending on various factors. Here's a breakdown. Potential for higher volatility. 1. Options component. QYLD's covered call strategy involves selling options, which are inherently more volatile than underlying stocks. This additional layer of complexity adds to the ETF's overall volatility. 2. Volatility skew. The options used in the covered call strategy might have a volatility skew, meaning the implied volatility is higher for calls, which QYLD sells, than puts. This can amplify the impact of market movements on the ETF's price. 3. Early assignment risk. If the stock price rises significantly, the option buyer might exercise their right to purchase the shares, forcing QYLD to sell them at the strike price. This can lead to sudden price drops in the ETF. Potential for lower volatility. 1. Downside protection. The covered call strategy inherently offers some downside protection against sharp stock price declines. When the stock price falls, QYLD keeps the premium received, mitigating some losses compared to owning the stock directly. 2. Limited upside. By capping the potential gains through covered calls, QYLD's price movements are generally less pronounced compared to the underlying index during strong bull markets. This can limit the overall volatility compared to the broader market in specific scenarios. 3. Income generation. The consistent income generation from the covered calls can provide some stability to the ETF's price, potentially reducing volatility compared to more speculative investments. Ultimately, the volatility of QYLD compared to the broader market depends on 1. Market conditions. Volatility in the broader market can significantly impact QYLD's volatility due to the options component. 2. Specific options used. The strike prices, expirations, and volatility skew of the options used in the covered call strategy can influence the ETF's volatility. 3. Underlying stock price movements. The direction and magnitude of price movements in the Nasdaq 100 index can affect QYLD's volatility, particularly if early assignment occurs. Question 13. Why does the issuer believe that Nasdaq 100 covered call ETF's performance can meet the income needs of investors over time? It's important to understand that the issuer of the Nasdaq 100 covered call ETF, QYLD, cannot guarantee its performance will meet the income needs of all investors over time. However, they might highlight several factors that could lead them to believe it's a suitable option for some income-seeking investors here. Reasons for optimism here. 1. High and consistent income. QYLD's covered call strategy generates significantly higher income than passively tracking the Nasdaq 100 due to the premiums received from selling options. This income is distributed monthly, offering a potential source of steady cash flow. 2. Downside protection. While limiting potential upside, the covered call strategy provides some protection against significant price declines in the Nasdaq 100 index. This can help mitigate income disruptions during market downturns. 3. Diversification within growth. QYLD offers exposure to the Nasdaq 100, a well-known index of growth-oriented companies. While growth sectors can be volatile, they historically offer higher long-term returns, potentially supporting consistent income generation. 4. Tax-advantaged income. QYLD primarily distributes income as non-qualified dividends, which are taxed at a lower rate for some investors compared to capital gains taxes. This can be beneficial for income-dependent individuals seeking tax-efficient returns. Important considerations here. 1. Limited upside potential. By selling covered calls, QYLD caps its potential gains if the stock price significantly rises. This can underperform the underlying index in bull markets, potentially impacting income generation over time. 2. Higher volatility. The covered call strategy can lead to higher volatility in the ETF's price compared to other income-generating options. This can create uncertainty and potentially impact income stability. 3. Sustainability of strategy. The effectiveness of the covered call strategy in generating consistent income depends on market conditions and the issuer's ability to adapt the strategy accordingly. Past performance is not necessarily indicative of future results. 4. Individual needs. QYLD's suitability depends on your specific income needs, risk tolerance, and investment timeframe. It might not be suitable for everyone seeking income, especially those prioritizing capital appreciation or needing guaranteed income levels. Question 14. Why does the issuer believe that Nasdaq 100 covered call ETF's strategy aligns with the long-term investment goals of professional investors? Here are some potential reasons why they might believe the Nasdaq 100 covered call ETF's QYLD strategy aligns with the long-term investment goals of some professional investors. Potential benefits for professional investors are consistent income generation. QYLD's covered call strategy generates significantly higher income than passively tracking the Nasdaq 100 due to the premiums received from selling options. This income stream can be used for various purposes by professionals, such as 1. Supplementing portfolio returns. Enhance overall portfolio returns with a steady income stream. 2. Meeting specific investment goals. Generate income for specific strategies, like meeting client income needs or funding retirement plans. 3. Hedging other holdings. Use QYLD to provide some downside protection for other, more volatile investments in their portfolio. Downside protection. While limiting potential upside, the covered call strategy offers some protection against significant price declines in the Nasdaq 100 index. This can be beneficial for professionals managing risk for clients or portfolios, especially in volatile market conditions. Diversification within growth. QYLD offers exposure to the Nasdaq 100, a well-known index of growth-oriented companies. While growth sectors can be volatile, they historically offer higher long-term returns, potentially aligning with professionals seeking long-term capital appreciation alongside income generation. Tax-advantaged income. QYLD primarily distributes income as non-qualified dividends, which are taxed at a lower rate for some investors compared to capital gains taxes. This can be beneficial for professionals managing portfolios subject to tax considerations. However, it's crucial to remember 1. Limited upside potential. By selling covered calls, QYLD caps its potential gains if the stock price significantly rises. This underperforms the underlying index in bull markets, potentially impacting long-term capital appreciation. 2. Higher volatility. The covered call strategy can lead to higher volatility in the ETF's price compared to other investment options. This can be stressful for risk-averse investors and might not align with all professionals' risk tolerance. 3. Fees and expenses. Implementing a covered call strategy adds complexity, leading to higher fees compared to passively tracking ETFs. This can erode long-term returns for professionals managing costs closely. 4. Not suitable for all professionals. QYLD's limited upside potential and higher volatility might not align with all professional investors' objectives, especially those focused solely on maximizing capital appreciation or seeking lower-risk investments. Alright, ETF fam, we've dissected QYLD, explored its income-generating potential, and navigated the risks involved. So, is it the golden ticket to early retirement, or a high-wire act waiting to snap? Ultimately, QYLD can be a powerful tool for income generation, but it's not a one-size-fits-all solution. Consider your goals, risk tolerance, and investment horizon before diving in. For more on QYLD, income investing, and all things ETFs, head over to the description below. We've got some awesome resources lined up for you. Remember, knowledge is power, and here at Chat ETF, we're all about empowering you to make informed investment decisions. Thanks for joining the conversation. Like, subscribe, and comment below.